Hello everyone, I'll be recording this video to go over exam 2 to help you guys prepare for the next exam. This is just a practice exam that will help you prepare. So the fraud triangle contains three elements that must exist for accounting fraud to occur. This answer is going to be D, incentive, opportunity, and rationalization. Sorry about that. And then 2, which of the following was passed by Congress in response to the financial statement frauds that occurred in the early 2000s? That's Sarbanes-Oxley Act that helps protect investors from fraud. So then 3, protecting against theft of assets and enhancing accounting information. This is the objective of internal controls. Internal controls are the rules and procedures by a company to ensure integrity of the company. All of the following are internal controls, except this one is going to be minimizing the amount of income tax paid. That's going to be C. Assigning responsibilities, so the related activities are assigned to 2 or more people, is segregating duties. So you want to put it to different people so multiple people aren't doing all of the work. If a company hires an auditor to check the work done by others, it's supported by documentation. It is doing so under the principle of control activities. That's independent verification because they have to be independent from the company. Which of the following is not an example of internal control? That's customer satisfaction surveys. So internal control is going to be internally in the company. A customer is going to be external. And then 8, a system used to reimburse employees for expenditures that they have made on behalf of the organization is referred to as the petty cash system. Blank sell their inventory to blank for resale to customers. This is going to be wholesalers to retailers. So like a wholesaler would be like a manufacturing company and a retailer would be like Target or Walmart. Sales revenue reports the selling price times the amount of quantity sold. That's D, so that's just the standard formula. Then seasons have 42,000, then beginning inventory of 49,000, then purchases of 24,500, and then ending inventory of 3,500. So to find this amount of the cost of goods sold, we would take the 42,000. Doesn't let me right there. 42,000. And then we add in our beginning inventory. Then we'll subtract out our purchases. And then we'll add back our ending inventory. So that gives us cost of goods sold. On that answer, you should get 25,900. And then next, a blank inventory system will always give updated balances for blank. So this answer is going to be perpetual and then cost of goods sold, so D. So perpetual means continuously. So that's why when you do those, you're going to keep updating it after each purchase. In order to calculate shrinkage, you would use a perpetual inventory system that requires an occasional count of actual inventory. It's the easiest way to calculate shrinking the assets because it's going to require accounts each time. Clarendon Corporation sold 1,000 of merchandise to a customer on terms of 1, 10, and 30. The customer paid within the discount period as a result of a customer. The total assets would be, this is going to decrease by 10. And the reason it's going to decrease by 10 is this 110, that 110 right there, that means basically 1% in 10 days. So it'd be 0.01 times this 1,000 gives you 10. And then 15, the Queen buys premium at a cost of $3 per gallon, sells it for $8. The selling and admin expenses are $150, which the following is correct. This answer is going to be the gross profit per gallon is $5. So the way we found that is just $8 minus our $3, so our sales minus costs. And then for 16, Kelton reported net credit sales of 310,000. For the current year, the unadjusted credit balance in its allowance for undoubtful accounts is 525. They experienced bad debt losses of 2% of credit sales. In prior periods, using the percentage of credit sales method, what amount should you record as a bad debt expense? So we should record this 310,000 and multiply it by our credit sales of the 2%. So that it's going to give us 6,200. So that's going to give us D. So that's all the multiple choice. Now for the short answer, we're doing a bank rec. So we're going to do the bank side and the book side. So for the bank, we would start with ending balance per bank, which is going to give us 1490, which is given to us right here. Then when we're doing the bank side, we always add deposits in transit. So that is going to be 1350 right here. And then we always deduct outstanding checks. Oh, sorry, there's one more thing we have to add in. We also have to add in the bank error, which is 325, because they draw out another company in error. So the bank error, 325. Perfect. And now we're going to deduct outstanding checks. Sorry. Outstanding checks of 1295. Sorry, this chart is being weird. So then our up-to-date cash balance gives us 1870, which is found by adding up the ending balance plus our additions and subtracting out the outstanding checks. You could total these up here if you wanted to do the total additions and then total, but you don't have to. Now this is going to be book. And you're going to add, first we're going to do ending balance per book. There's going to be 1145, which is found right here. And I forgot to mention the outstanding checks are right there. So now for the book side, we're going to add an EFT received. And that's going to be 925 found from here. And then we are going to deduct an NSF check of 175, and then a bank service charge of 25. Sorry, 175, 25, which is right here. So essentially these are going to be standard items that you put in on the bank side and the book side. They'll never be flip-flops or something else you can really put in these that you would learn in this class. So if you can memorize this and understand it, you should be good to do this on the exam. And a good way to check is that your bank and your book should equal. Okay, now we're going to do, so it says the following information for manner uses a perpetual. So perpetual means continuous. They gave us this information and now we're finding FIFO and weighted average. So to find FIFO, that's first in, first out. So first, so we sold on May 1st. So these items are before May 1st. That's what we're looking at right now. But first, so since it's first in, first out, we're starting with our beginning inventory. So we're going to take our 15 from the beginning inventory times our 65, which gives us 975. So that just stays the same. And now since we sold 35 units, we are going to take 25 times 71. Or sorry, we're only going to take 20 times 71 because, and this reason why we're only taking 20 from here is because the 15 and the 20 have to equal 35. So we're only taking 20 from the March 28th purchase. Take 20. So now we currently have 5 remaining that we're just going to keep in mind. But now we are going to just put that so we don't get confused. So if the 5 remaining is because on March 28th, we normally have 25, but we only used 20. So now we're going to take, this is what we sold it for. So just to keep that in reference. So now the 5 remaining is going to be 5 times 71, which comes from the unit cost right here, which gives us 355. And then since we're looking at this, since we already did May 1st, now we're looking at October 28th. So we already took the 5 left from March 28th. So now we're looking at August 22nd. So there's normally 30 there, but since we only need 25 more, since we only sold 30 units, we're just going to put 25 here times 75. And that's going to equal 1875. So if you add up all of those numbers on the right there, you'll get your cost of goods sold for 4625. So then 4625. And then in order to find your ending inventory, you would take goods available for sale minus cost of goods sold. So our goods available for sale, we found up here in the question, right here, 7835. So that's going to be 7835 minus our cost of goods sold that we just found. This is 3210. So that is our FIFO. Now we're going to do weighted average. So weighted average, essentially we're finding our weighted average unit cost. And when we go through it, it's perpetual, it's continuous. So we do it after each purchase. So first we start with our beginning inventory again of 15 times 65 equals 975. And then we do a purchase of 25 times 71 equals 1775, which comes from right here, 25 times 71. And now since it's perpetual and we have to continuously do it, we're gonna total up our units here, which is 40. So this what we're doing right now is available for sale. Available for sale. So that's 40 units. And then if we add up the 975 and the 1775, that gives us 2750. So now just over here, we're going to calculate the amount that we're going to use for our sale. So it's going to be 2750 2750 divided by 40, which equals 68.75. And now we're going to go to our sale. We sold 35 units, which is shown up here on May 1st. And then we're going to do times the 68.75, which is going to equal 2406.25. So that's our first cost of goods sold. And now we move on since we still have some more purchases. So now we're going to take our 30 times the 75. So that's up here, August 22nd, which equals 2250. Then our another purchase of 35 times 81 equals 28.35. And since we have 40 right here and are available for sale, but we only sold 35, that means we have 5 units remaining. So we just have to take that into account for our units. So now our total units would be the 30, the 35, and the 5, which would equal 70. And then we would add up the, first we're gonna keep that separate so far. We'll add up these two amounts. So we'll add up this 5 remaining times the amount that will give us 343.75, which is the 5 remaining times the 68.75. So then our total units is 70. So when we add these 3 up, we'll get 5428.75. And then we do the same thing that we just did. And when we do that, that should give us another decimal. Let me put that there. So 5, let me just put this real quick in here so you know. Okay, so now we're going to take this 5428.75 and we're going to divide by the 70 total units, which gives us 77.55. And then we have this. Oh, sorry, this system is being super weird. I'm just going to do it down here. See how I can fix that. It keeps going up there. Okay, let me just start from down here. So now we are going to stop there for that part. But now when we find our sale, so we have one more sale of 30 units times the 77.55, which is going to give us 2326.61. And then next, after that, to find our cost of goods sold, we would take the 2326.61 that we just found in our sale, plus the other sale, the 2406.25. So that gives you a total cost of goods sold of 4733. Now to find ending inventory, we're going to take 40 units left. So we had 70 minus the 30, that gives us the 40 times 77.55, which gives us 3102. So that's going to be weighted average. Sorry, it doesn't look the cleanest. It's hard to do typing it. And then lastly, we're going to look at our total accounts receivable and our historical uncollectibles. So the way this question works is you essentially are taking each one and multiplying them by the other. So the accounts receivable times the uncollectible. So 126,500 times 0.02. So that's 25. Let me put this here. So 126,500 times 0.02, that equals 2530. And then 89,200 times 0.12 equals 10,704. Then 53,600 times 0.18. Sorry, 53. That should give you 9,648. 31,800 times 0.35 gives us 1130. hold in 130. So then we're gonna add these up. And when we do that, 8 plus. We're gonna get 3412. And then we're gonna find 34,012 minus our credit balance, which is this right here, 28, minus our 28,947, which is going to give us 5065. That's our number we're going to be using. So this 3412 is our adjusted balance. The 28,947 is unadjusted. So then the 5065 is the amount that we're using. So bad debt expense of 5065. And then for our debit, and then allowance for doubtful accounts for our credit. That's about it. The answers are all down here if you need a cleaner look. But if you have any questions, feel free to email me. All right. Hope you guys have a great rest of your night and good luck.